Perfect. All right, everybody, we're going to go ahead and get started. Thank you so much for joining us today. My name is Nina, and I'm the Associate Director of the Tulane Alumni Career Professional Development Office. And so, just a few housekeeping things before I hand things off to Sydney and Dan. Please introduce yourselves in the chat and let us know where you're joining from, because it's always fun to just kind of see the different places where we're all connecting from. So, this session is being recorded and it will be uploaded to our YouTube channel. I will drop that link in the chat in a second. We have over like 70 past sessions that you can check out there for different resources. And if you'd like to be notified when new recordings drop, you can subscribe to our channel. So yeah, I'm gonna hand things over to Sydney to kind of make an introduction for Dan. If you have any questions throughout, you can put them in the chat and then they'll be circled back to at the end or throughout. Yeah, so I'm going to hand things off to Sydney, but thanks so much for being here, everybody.
Sounds great. Thank you, Nina. Hi, everyone, and welcome to our webinar, Avoiding 5 Costly Mistakes When Hiring a Financial Advisor. I'm Sydney Temple, a member of the Rebalance family, and we are really excited to present here with you at Tulane today. We actually have a number of our financial advisors and other company employees and team members that have children or other relatives that are alumni of Tulane. So this is a school that we feel really connected to, and we're excited and honored, honestly, to be here with you today. So thanks for having us. I'll start off just by introducing our speaker, Dan, and give you a little bit of background on Rebalance as well. So Dan Mavraides brings over a decade of experience in the investment world, including a successful tenure as Senior Vice President at Evoke Advisors, where he oversaw significant growth in assets under management. He's a Princeton graduate, and he's also a former Division I basketball captain, and he played professionally and served as USA national team captain for 3-on-3 basketball. Dan is passionate about wealth management and making a difference through community advocacy in Los Angeles, and we're looking forward to learning from him today. So welcome, Dan.
Thank you, everybody. It's great to see everybody here and really looking forward to speaking with you today.
Thanks, Dan. And now that you know a little bit about Dan, I'll give you a quick rundown on our firm. Rebalance has over $1 billion of client investments or assets under management, and we are proud to call ourselves consumer advocates, so much so that we actually testified before the US Senate on behalf of investors and are the only registered investment advisory firm to do that. We also comprised our investment committee with some of the brightest names in the investment industry. That committee includes Charlie Ellis, who, along with Vanguard founder John Bogle, helped spearhead the index investing movement, as well as Burt Maciel, who wrote a few books you might have read in economics class, one of them being The Elements of Investing. It also includes Jay Vivian, who previously managed the retirement investments for IBM, and Christy Craig, who is the Chief Investment Officer at the National Geographic Society. We are also proud to have earned several prestigious awards for our commitment to excellence and client success, including Best in State Wealth Advisor by Forbes and Best Financial Advisory Firm by USA Today. These accolades reflect our team's dedication to delivering top-tier service and support for our clients. So this is my last slide before I turn things over to Dan. I do want to let you know that we have a chunk of time dedicated at the end to question and answer with Dan. So if you have a question come to mind during this presentation, please just submit it using the chat box at the bottom, or you can submit it to me directly, and we'll try our best to get to all of your questions either throughout the presentation if it makes sense or at the end. So with that, Dan, I'll turn it over to you.
Wonderful. Thank you for the introduction, Sydney. Well, as I mentioned, it's great to be here today. A big part of our firm and our approach to this industry is financial education and literacy, not just with our clients, but with bodies like yourself and other universities and institutions and communities that are interested in learning. And so we're really happy to be here today. And I hope you have a few really concise takeaways to help you in your framework for evaluating financial partnership in the future. And so that's what we're talking about here today. As we all know, choosing an advisor is a big decision. You want to find someone to work with who's smart, clearly, an independent thinker, trustworthy, a high priority, and someone who's a thought partner. They should be able to help you think through financial and investment decisions across your life and provide data to help support their suggestions. And so the reason that we highlight this topic so frequently is that it's really challenging to decipher who is a good advisor and who might be more of a good salesman or saleswoman. And so just like when you go to a mechanic, if you're not familiar with cars, you have no idea really a framework to how to evaluate that. So the title of this presentation is the 5 costly mistakes to avoid when choosing an advisor. And this chart here that we're leading off with is kind of the meat and potatoes behind that. So this shows, this research is done by a firm called Dalbar, and they're a really prominent research firm that puts out advisor-related data and investor-related data. And so the chart reflects the last 30 years of investor returns. And there's really two camps. There's the investor that stayed invested throughout that 30-year period. If you invested in just a simple stock bond 60-40 portfolio, you would have earned 8.1% over that time frame on an annual basis. And the big issue here is that the average investor over that same time period earned only about a quarter of that, 2.5%. So the difference between those two is what we call the investor gap. And that's what this presentation today is really to address, is why is the average investor earning 5.6% less than if you stayed in the markets over, a 30-year period? You should really be earning closer to this 8.1% return. And so these mistakes that we're going to highlight that you can avoid will help close that gap and allow you to be the investor on the right. So I'll reference this investor gap throughout the presentation, and we'll talk about how to avoid being the average investor. So this next slide shows a little bit more of the numbers behind this gap through time. So 5.6% might not sound like a big difference. If you think about in other aspects of your life, when you're tipping your server, you may give a 20% tip. But what's really happening here is the compounding effect. So this slide shows the investor gap compounded over a 30-year period. When you look at year 0, you're starting both portfolios with $100,000. And in the first year, the gap's going to be $5,600, that 5.6%. After 30 years, that compounding results in a $640,000 difference. And the average investor has only 25% of the amount of money. And so, that's staggering. And this is what can happen if you partner with the wrong financial partner. So the goal of today's conversation is discuss how you can avoid being the average investor and really focus on increasing your long-term returns. Okay, so here's a special overview slide with the 5 topics. As Nina mentioned, we're going to send out this information after, so you'll be able to reference it at your leisure. No need to take frivolous notes because you'll be able to reference it. So these are the 5 mistakes. The first is listening to the siren song. This is the alluring but often misleading belief that you can outperform the market through stock picking or market timing or active trading. The second is high fees and unnecessary taxes. This point for many of you is going to be more self-explanatory, but it's a major part of your long-term investment success. So the industry is, whether you're aware of this or not, is riddled with hidden fees and complex fee structures. So the big wirehouses and insurance companies, and they can continue reporting positive quarterly earnings. And so there's a mismatch between the services they're offering and the fees they're charging. The third is partnering with the wrong experts. An advisor that doesn't understand your goals and who you are as a unique individual can be a major detractor to financial planning. The fourth is conflicts of interest. A large part of the advisory industry is filled with asset gatherers. So firms that are really looking to grow their AUM by any means necessary to increase their fees, and marketers that are trying to pitch you their own products. So we're going to go through some signs to help you evaluate, is your advisor more on the sales side or more on the research and advisory side. The fifth point is misunderstanding risk. Returns can be still challenging to compare, but at least you look at one fund or one company versus another, and you can say, hey, this one did better than this one. Risk-adjusted returns are much harder to compare, and it's because it's not clear. So you really need to understand what the underlying holdings are and what you're investing in and how much risk you're actually taking to generate the type of returns you're targeting. And so this is paramount to constructing an appropriate portfolio for your long-term goals, but is often not addressed. So we'll start with the first point, which is listening to the siren song. So you can raise your hands here. How many people have seen this guy? I'd bet most. This is Jim Cramer, if you're not familiar. And he's a good example, even though he's a little outdated at this point in financial media. He's a good example of understanding that the investment management business is that most people are trying to outperform the market over the short term, and they're not long-term focused investors. And so, like Jim Cramer, if you follow the financial news, what you'll hear is some CEO talking about why his company is going to beat quarterly earnings, or a new entrepreneur talking about why this sector's the hottest space to be in, and why you should overweight your portfolio here, or shift away from this sector. And that's all short-term focus investing. And that's one of the quickest ways to end up as the average investor versus the long-term investor. So, whatever network news you follow, take it with a grain of salt, and it shouldn't be your guiding force in terms of making investment decisions. So, people like Jim are really great at their job. They're great speakers. They have a good narrative about the markets, but that's a quick way to get caught up in the short-term approach of what's hot now. This is a good example of why it's hard to trust the experts in being active around your investment approach. This is a forecasting track record. We update this every year. We need to add in 2024, but it shows all the big banks that you're familiar with: Bank of America, Barclays, Credit Suisse, Goldman Sachs, and it shows their forecasting expectations for the S&P 500, which, as you know, are the 500 largest companies represent a good portion of the U.S. stock market and really drive a lot of that growth. And their average forecast was, $700 off from where the S&P ended that year. And to show you, none of them were really that close. So we have, as I mentioned, every single year we look at this chart, it just continues to be the same, that either they expected better returns or worse returns, but no one was able to accurately forecast what happened. And so it's just a good reminder that if you're speaking with someone who claims they know what's happening next, that is not a good sign of a good investor. No one can really predict what's gonna happen next. So on the next slide, this shows the markets beat the pros. So actively managed mutual funds that underperform their benchmarks consistently. If you look over at the 20-year period, 92% of actively managed mutual funds underperform their benchmarks. Just let that sink in for a second, because to me, that's a staggering number. And so it comes from this misunderstanding that large investment firms with access to better research and trading algorithms and hedging strategies are able to beat their benchmarks, but the data just doesn't support that. So, when you hear this, you're either thinking, hey, I have to be really, really good at picking who the best mutual fund managers, money managers are going to be, or I need to get really lucky to be in that kind of 8% category of those that outperform. So it's a very high bar to beat the markets with active trading now, and the data doesn't support that most can do it. So the emotional appeal of active investing. Typically, investors are looking for the best performing funds over recent years, and they extrapolate that recent performance into the future, thinking that they'll be the best performers next. And that's rarely the case. And counterintuitively, it's actually the opposite. So usually the best performers tend to be the middle of the pack or underperforming in the following years. And so the reason behind this is because environments shift, market environments shift. And so one strategy that does well when US stocks are performing well or when there's economic growth might not do well when there's a rising inflation environment or when we have other risks at hand. And so I would say it's nearly impossible to create a strategy that's going to be the best performer across market environments. And that's where diversification comes into play, which we'll touch on. But the idea is not to get caught up in the hottest stock tip or which new cryptocurrency is coming out that your friends are talking about at a work event or at a gathering. Boring is good for investing, and it's there's some old adages that still ring true today. Time in the market beats timing in the market. So being long-term focused investor, not trying to outperform by putting material amounts of your capital at risk in short-term focused investments. So that closes up point one, and listening to the siren song, getting away from short-term investing, really focusing on long-term historical data and sticking to your plan. And now we'll touch on mistake two, which is high fees and unnecessary taxes. So this is a more clear point, but very vital to long-term investment success. This table shows some firms you're probably familiar with: Wells Fargo, Merrill Lynch, JP Morgan. And an important part about fees is first understanding what you're paying. And so we'll talk through the two different types of fees there are. At the highest level, you have an advisory fee. So when you work with a financial advisor, you're going to be paying that firm a fee to manage your assets. Traditionally, it's an asset-based fee, which is a percentage of the assets that they're advising on your behalf. That fee at most of the big banks can range here. You can see in the advisory fee column from 1 to 2%. And we'll talk about how that eats into your pie in the preceding slides, but that's one aspect. The other fees that you're going to be paying are fund fees. So if you are invested in ETFs or mutual funds or any product that holds a bucket of stocks or bonds or securities, there's a fee associated, and they can vary vastly. You can have very low cost investments and you can have very high cost funds. So when you add both those together, for the most part, there may be transaction fees and opening and closing costs, which we can talk about in more specific products, but these are the two you're definitely gonna be paying, and you wanna add that up. And our focus, our business model is based on coming in well below the average of fees. And we think that most advisors should follow suit there. So we talk about these fees, okay, 2%. Again, what does that really mean to my return? A lot of people think that they're going to be earning 25% in financial, in public markets on an annual basis, which is not the case. The average, a well-diversified portfolio may be 7 or 8% on an average annual basis. And 2% is a large portion of that. If you're earning 6% annually, that's a third. And so that's one of the biggest reasons investors find themselves becoming the average investor, is too much of their earnings are going to the people managing their money. It's important to figure this out and understanding that compounding through time. Finance industry makes roughly $17 billion a year, and that means you could be losing up to 30% of your potential returns without even knowing. So don't think of 2% as 2%. Think of it as a third of, or a quarter of your potential earnings. So this is talking about active versus management. So active versus passive investment approaches. And so we've been talking about this short-term focus. There are camps that are looking to outperform the market by actively picking stocks, selling stocks, going in and out of different sectors. And for that, you're going to be paying a higher fee. So not only do you have a very low chance of outperforming the market by being with an active manager, you also are going to be paying a higher fee for that service. And so you're getting hit. It's a double whammy of negative compounding over time. So we go back to that slide, the average active mutual fund has an 8% chance of outperforming, 92% underperforms. So you're really giving yourself a challenging time there. And the good thing is there's solution for this. There's products that are widely used now. Trillions of dollars are invested in them in index funds, and they can track a specific market or asset class And because there are so many assets that have flown in to these funds, the fees have been really compressed. So you can get into these passively managed index funds for a really, really low cost, a fraction of what the active funds cost. So here's the advisory fee trend, kind of at different amounts of assets that you'd be advising. And traditionally, the more assets that you invest with an advisor, there'll be a reduction in their asset-based fee at different breakpoints. It's another thing to be aware of. Are you close to a breakpoint, and can you start, reducing your weighted average fee? And so if you have any questions, one thing that's always we like to do is a complimentary fee audit. So if you're unsure about what you're paying, reach out to us. We'll provide how you can do that. And we're happy to do a fee audit for you. Look at your underlying holdings and the advisor you're working with and give you an idea of what that is. Because it's just an important piece. Also around active management. Active management, selling in and out of positions actively, creates a really tax inefficient model. And so what happens is you are buying and selling in the short term. And when you do that, when you hold an investment for less than a year and you sell it, any of the gains are considered short-term gains. And that means they're taxed like traditional ordinary income. So whatever your salary is that year and you bring in across different businesses, that is also going to be added to that. And so it may bump you into a higher tax bracket. It's an inefficient way. Conversely, if you hold an investment for longer than a year, longer than 12 months, when you sell it, it's taxed as long-term capitalized gains, the earnings are. And that's a much reduced rate relative to what your ordinary income is going to be, at least at the federal level. Sometimes states can be the same, but at the federal level, you're going to be paying a much reduced rate. So it's far more tax efficient to stay invested for the longer term than to be actively trading in and out of positions. So it's another headwind you have if you're an active manager. Not only do you have a low probability of outperforming the market, you have higher fees to overcome, and then now you also have higher taxes that you're going to be paying. And so it's really not helpful for wealth creation. And what you want to be doing on the opposite end is staying invested for the longer term and benefiting from the compounding, only realizing the long-term capital gains when you need to make a withdrawal or adjust the asset weightings in your portfolio. Smartest investors capture the market returns. So this chart, I really like this chart. It goes back to 1950 and shows rolling returns over that period. So 5-year rolling turns would be 1950 to 1955, 1955 to 1960, and so forth. And this is over, a 73-year time horizon through 2023. If you look at this chart, stocks are in orange, bonds are in green, and then a 60-40 portfolio, which is 60% stocks, 40% bonds, kind of this traditional understanding of a moderate risk portfolio. That's in blue there. And so the first year represents what could happen in the worst and best year over that 70 period in this 1-year time frame. So stocks over this time frame in the best year, they could be up 40% and they could be down 39%. Bonds could be up 43% and could be down 13%. And a standard 60-40 portfolio could be up 34% or down 20%. The idea is this is a huge amount of variability, right? And so what you want to do, this is essentially the short-term investor trying to beat the market. And that's why you have such big swings. And so to avoid some of these potentially catastrophic drawdowns on this side, if you choose the wrong investments to be in, is to be diversified into this 60-40 portfolio or some mix of stocks and bonds or different assets that are correlated to go up and down at different times during different market environments. And so when you look over the longer term period, if you were in this 60-40 mix, over a 20-year rolling period, over this entire time frame, the lowest you would ever have returned is 5%, positive 5%. And then the best over that period would be 15. So you're really reducing your volatility and your range of potential outcomes, particularly on the negative side. Even if you go to a 5-year rolling period, the worst return you would have experienced would have been a positive 1% return over this entire time frame. So you see the variability of outcomes reducing as you shift to the right and staying invested over the long term, and you end up with a really attractive return. This is the average returns over that period. This 60/40 portfolio delivered a 9.3 annualized return. Stocks were better, but with a lot more volatility, and you're over-concentrated, submitting yourself to potential big drawdowns. The takeaway is that you don't need to be an expert to make money in the markets. You don't need to try to game the system. Smart investors capture the market returns over time. Even Warren Buffett, everyone's favorite, big name investor who's done tremendous things and, has really, really helped a lot of people find good companies to invest and stay invested in. He, when he's all said and done, he wants 100% of his estate in index funds. So he's of the passive long-term approach. And on the next slide. Oh, looks like Sydney's connection might have dropped.
Yeah.
Apologies, team.
There
Yeah,
she
she
is.
should be
She's
back in a
back.
second. Yeah, it's okay.
I'll
It'll
make
give me a...
sure. I'll make sure she has screen sharing.
Great.
Hey, Sydney, can you hear us?
I can. My internet must have gone down.
No worries. Do you still have screen sharing abilities?
Yes, let me pop that right back up. Can you see?
Perfect.
Go back a
Yeah.
second. Dan, I think we were right.
Yes.
All right, here we go.
Perfect.
Great.
Guys.
Great. So we're on to mistake 3, which is partnering with the wrong experts. Now, this is not going to be as clear as high taxes and fees, and so we'll get into that. But this can have you on the wrong side of the investor gap. Sydney might be losing service again.
Let me try turning off my video. I don't know why that's happening.
Great. Thank you, Sydney. Great. So this can have you, yeah. So partnering with the wrong experts. This will have you on the wrong side of the investor gap. The important piece here is your conversation with an advisor. So how do you choose the right expert? Your conversation with the advisor, it shouldn't be based around investment products and what new bells and whistles you must invest in, kind of what we talked about, the siren song. It should be about learning who you are. So your initial conversations with an advisor, they should be asking a ton of questions. And in my opinion, a great meeting is when the client, I really get to understand the client and what are their biggest challenges. What are they, digging deep in that down, what's important to them? Is it legacy, saving for their children? Is it making sure they have enough to, live off during retirement? Is it understanding how to grow their wealth? How do I transition that? So they should be asking you a lot of questions to the point where they really understand your past experiences, your investment knowledge, and really how did they back into your target return rate? How did they come up with that? Just based on your age and your assets or your income? Or did they really say, hey, we've done financial modeling to a degree where this 6% return is going to allow you to meet your goals? So that's important. And so, traditionally you'll see a lot of different products on here. These are things that are not useful to being an advisor. The takeaway is to reflect on the person you're speaking with, and are they interested in learning about you, or are they kind of pitching you different products that are new in the venture space or hedge fund world or a private real estate deal? So this is a clear table you can always reference of what help does matter and what doesn't matter. So on the left, these are certifications that are very useful in certain parts of the financial world and are very well regarded. The CFA, Series 7, life insurance, stockbrokers, venture capitalists, stock pickers, but that doesn't help you with your long-term goals for growing and protecting your wealth. What does matter is someone who's talking about your investment mix, working with individuals that are certified financial planners, people that are experts in behavioral finance and discipline, and that have a structure set up to help you with estate planning and mitigating taxes through time. So, it's important to understand who you're working with and what their expertise is. This study done, it's on the biggest determinants of portfolio performance. And so meaning what impact across these 4 items, what impact they have on your actual returns. And so you'll notice that asset allocation is the dominant factor by a lot, 92% of the pie. And so that's where your conversation should really be focused. It's such a large piece because market timing, security or stock selection, those are all completely insignificant. And how your portfolio is invested is really what's going to affect your long-term success. So find an advisor who can walk you through their asset allocation philosophy in clear terms, how they've come to that. And I would favor philosophies that are rooted in more long-term data and a focus on achieving the right risk-adjusted return for you. So this is your investment mix, or asset allocation. It really defines what type of return you're targeting. So this exhibit shows annualized return ranges and averages for different types of stock and bond mixes over 120-year period, dating back to 1901, to give you an idea. Because a lot of times advisors will pitch, hey, here's a new product that's going to earn you 25% annually, and that's not going to happen. And so it's good to have a framework to understand what do these assets actually generate historically. So I have an idea of who's presenting something that seems like an outlier, and I can dig into it deeper. And so to give you an idea, if you look at on the left, 100% bond portfolio over this entire period, the lowest return was minus 15%, and the highest return was 20%, and the average is 4.7. All the way to the right is 100% stock portfolio. And the average is 8.1%. And so you have some averages there, across those mixes. And so you'll notice the more stocks that you add into the portfolio, which are a higher risk and higher returning asset than the bonds, the expected return of the portfolio and average return is going to go up over time. So it's important to make sure you're in the right bucket here. You're not taking an undue amount of risk to reach your goals. And it's vital that an advisor walks you through these discussions. So that's something that should be happening. And talking about kind of, the right experts to work with, we are really based in academic research, and our committee was devised with that in mind. And I think that's just an important piece. I went through the process of switching firms last year, and the reason I chose Rebalance, a big piece of it, was because of our investment committee that Sydney talked about and our data-driven process around asset allocation. And so you should feel the same confidence with your team and your advisors when you choose to work with someone, when you're trusting your net worth and assets with them. The CFP, just to touch on that in a little more detailed, the certified financial planner is someone, it's a really rigorous program, and it's really focused on the wealth management umbrella. So as I mentioned, insurance analysis and tax analysis and estate planning, and not just the investment piece, but everything else that is equally critical. So it's kind of like the MBA for financial planning. Insurance and budgeting and retirement planning is a big piece. So, having advisors with the CFP, that is a very useful designation. To talk a little bit more about what a financial plan is before moving on to the next point, a financial plan is essentially, it should be more than just a static a review of your current assets. So you can pay a couple $1,000s to someone, maybe ranging from a couple hundred to a couple thousand, to tens of thousands, to review all of your assets, your expenses and income, your goals, your mortgages and liabilities, and provide a one-time kind of static overview of your financial health and probability of success of meeting your goals. But really, they should be utilizing a software, financial planning software, which are readily available to RIAs now, and they're very useful for future projections. Now, it's just one aspect. The key disclosure in all of our industry is past performance is not indicative of future results, but it's useful to have some projections and forecasting and a cohesive strategy of this is the direction we want to go and why. And so these are some of the things that can be discussed during a financial plan. And really, it should also help inform your asset allocation discussion. So coming up with that stock to bond, real estate, whatever you have in your portfolio, that should really be a byproduct of the planning that we've done. These are the objectives you need to meet. And now this is how we're going to implement that portfolio. So work with someone who has a good financial planning team. Point 4 are conflicts of interest. Now, to give you an idea of the evolution of our industry through time, some of you may remember, I'm not sure how old our audience is, but decades ago, really, you would hire a stockbroker, maybe UBS or Morgan Stanley or Merrill Lynch. And these independent brokers, then independent brokers came in and they reduced those fees to investors. But it wasn't until really an investment advisor came in that you had this change from this stockbroker model, commission-based model, to those that were fiduciaries that are regulated by the SEC and law to act in your best interest. And so that was a big disruption. And another change was the introduction of the index fund and this ability to, for a very low cost, get exposure to market returns that can compound over time. And so now in the modern world, you should be looking for an advisor that is tech-driven, that's looking to utilize technology to improve the services offered, improve their research, and through time, there may be fee compression due to that as well too. But they need to be prepared for that and be always improving their services. You should definitely be working with someone who is a fiduciary, as I mentioned, that is regulated to act in your best interests. And it's important to realize that our industry is still going through a major evolution, with the introduction of AI now. So you should continue to inquire about that with your advisor and ask them how they're implementing that. There are a lot of great resources now for firms to be able to provide even more specific advice across the wealth management field. And this is a graph that shows that assets managed by investment advisors have nearly tripled in the period from 2009 to 2019. And that trend has only continued since. So it's a reflection of investors choosing unbiased advice relative to what the big banks are offering. There's no product pushing and there's no conflict of interest because the independent firms are not pitching you products. They have the ability to invest across any custodians and with any manager and choose the lowest cost product they'd like. Again, the broker is the old model. There's really high commissions paid in the broker model, and you might not see them, but there's a reason that these companies are continually in the Fortune 500 and growing every year. Is there's a lot of fees. Their priorities are commissions and they're sales driven. And a fiduciary is advice driven. Their priority is your interests, and they traditionally have lower fees. Okay, our fifth and final point, which is misunderstanding risk. Now, this is a big one. I think risk is the hardest thing to evaluate in our industry. And for example, it's easy to choose a 9% returning product over an 8% returning product historically. But if the 9% returning product is taking twice as much risk as the 8% returning product, no one would invest in that. And if you were able to really, but that's just not apparent. And so on the next slide, one of the big risks that you're facing are low compounding rates. So this is one way you'll end up as the average investor relative to the long-term investor. And this risk is not relative. This is not talking about market volatility. This is more. So this is low compounding rate. So let me show you. If you look at, for example, a portfolio that earns 4% return annually, and after fees and taxes and all those things that we discussed, over a 25-year period, you would have earned 2.7 times your money. If you were in the same portfolio paying lower fees and not realizing unnecessary taxes from short-term trading and active management, and you were earning 7%, over 25 years, you would have earned 5.4 times your money. And so, you know, it's double that for a couple percent a year. So this is a big deal. And, you know, if you're in your 40s and you're accumulating years, it's just a major difference in the nest egg you're going to have come 65 when you're able to access those retirement accounts. So targeting the appropriate rate of return is essential. You know, you don't want to be too conservative if your portfolio needs to be invested in something a little more aggressive. You know, Albert Einstein, we're quoting the greats here. Compound interest is the eighth wonder of the world. He or she who understands it earns it, and he or she who doesn't pays it. So it can go both ways with the fees that we discussed, but your return, I mean, this is compounding is the best thing you have going for you. So another risk that isn't highlighted too frequently is inflation. Underperforming, going through periods of extended high inflation or a big change in inflation can really be a headwind for assets. And those environments eventually shift, but the real risk is not targeting a high enough rate of return to meet your future expense needs. So one thing that's hard to think about is, hey, I have my budget set for today. I'm able to save X amount of % of my income. This goes to expenses. This goes to goals. Those expenses change. You know, inflation traditionally runs at 2.25% something over time. So when you extrapolate that, that becomes really hefty. You know, if you look at an inflation rate of 3 to 5%, say 3%, your steak dinner, for example, is the point here, is going to cost significantly more. And so when we do the financial modeling and when your advisor is working on that for you, they're calculating those expenses in future dollar terms. And so that's something you always want to be outperforming. If you're underperforming inflation over a prolonged period, that is a headwind to long-term success. So that's the piece there. And good advisors, they help you stay invested through volatile times. So another risk that you have is mistiming the market, making emotional decisions, and selling when things are selling off. You know, there's most of the consumer sentiment is really this herd mentality. And so something will come out about a new company's earnings or a downturn in this sector, and people move money. And most of the time it's too late, and most of the time it's you're making the wrong decision. So if you look at this chart over the past 15 years, this is $10,000 invested in the S&P 500 from January 2003 to December 22. So if you stayed fully invested over that period, look at the difference here. You'd be earning $64,844 over a 15-year period. And this is the critical piece to understand. If you miss just the 10 best days in the S&P 500, you would have earned less than half that. So $30,000. And if you miss the best 20 days, it goes down significantly more. And the point behind that is there can be really short periods where the market bounces a lot. And we saw that this year. On April 8th, the administration suspended tariffs for the first time. And the next day, markets went up 10%, U.S. stock market. So if you miss that one day, you can see, for an 8% annualized return, 10% missing that day is going to be a major problem. And so trying to time markets, it is nearly impossible now. There's particularly with the introduction of AI, it's just getting more challenging, and it's a loser's game, really. The idea is to stay invested. Okay, so the key takeaways for us. Avoid advisors, focus on outperforming the market. That's the siren song point. You're not a short-term focused investor. You are looking to invest your assets and maximize the time that you are invested in financial markets. Keep key costs low. The fees and taxes will really eat into your returns over time. And so, having an idea of what those averages are, some of those slides that I shared, and where does your advisor place amongst those averages. Partnering with the right experts. Do your advisors ask you the right questions? Are they really interested in your goals? Do they know, who you are, what your family, is looking to do? And are they trying to help you reach those goals, or are they pitching you more products and telling you what the market's going to do next? So that's finding the right people to work with. And then fee-only advisors for unbiased recommendations. Don't get caught with the firms that are having you invest in all of their own products. There's not one single bank that has the best product for everything. It's not how it works. There's a lot of competition. And because of that, there are going to be other brokerages that come out with a lower cost fund that does the same thing. So why would you not want to switch to that? And then focus on the compounding. That's the big real risk. Let's find your target allocation and rate of return. Let's focus on keeping those fees and taxes low, and focus on how that's going to meet your goals through time.
Great. Thank you so much, Dan. This was great, and a great chance for us to get to learn from you about what we should and should not look for when looking for a financial advisor. So we appreciate your expertise. We are going to do a question and answer session. I've gotten a few questions submitted to me directly, but if anyone else has one, now's the time to either send it to me or put it in the chat box. Before we dive into that, I do want to say that a lot of times the questions we get are really specific. So if you have a really specific question where you want to talk about your personal situation, you can actually schedule using this QR code to chat with one of our financial advisors or chat with Dan to do a deeper dive with you and get those questions answered that might be more specific to your situation. So some of those common questions we get are, what am I paying in hidden fees? Like Dan mentioned, we'll do a fee audit for you. Or another common one is, am I invested appropriately with what I'm invested in right now? So these kinds of questions depend on a lot of different factors. So it's best to talk to us directly about your specific situation. So if those are the kind of questions you're looking for answers to, you can scan this QR code with your phone, and we can schedule a time to chat. But let's go ahead and jump into it. I'll start with a couple of the questions I've received. Dan, the first one is, I'm nervous about inflation. How will inflation rising impact my long-term investments?
Great question. Fantastic. Yeah, inflation, it's always something to be worried about. I'd say, the two biggest factors that affect asset class pricing today are inflation. Is it rising, falling? What are the projections? And economic growth. Is our economy growing, or is it shrinking? And by how much? And primarily, what are investors' sentiments toward that? Because the market dictates that. So do people, or the market is a reflection of what investors are thinking. And so in terms of thinking about inflation, it's just like other market timing questions. It's hard to tell. You can read a lot on both sides of people thinking, is the Fed going to cut rates? Are they going to raise rates? We have an idea of what's baked in because of the market, but the idea is to hold assets that do well during inflationary environments. And in that regard, then you're, in a truly well-diversified portfolio, you're almost not worried about what environment comes next, because there are things in your portfolio that are going to do well in that environment. Now, we can't predict which environment's next, but there are historical correlations that are very strong that TIPS, inflation hedge bonds, will do well in a rising inflation environment. TIPS are Treasury inflation protected securities, and they are bonds that pay out in yield inflation, what the inflation is rate, and sometimes a little bit of a premium. And so in a high inflation environment, those bonds are going to do well. Other bonds are going to do poorly. It's a headwind for bonds. It can sometimes be a short-term headwind for stocks, but stocks are a good store hold of wealth for the long term against inflation because they have true value. They're generating revenues. So there, so there are things you can be holding would be my answer to be well diversified and know that you have assets and investments that are going to do well in inflationary environments.
Great. Thank you, Dan. The next question I have is, in order for hiring a financial advisor to make sense for me, how much money should I have saved?
Another great question. There are different versions of financial modeling advice. And so, traditionally the minimums to work with an advisor start at a couple $100,000 and it varies. Different firms have different minimums. And but I would say it's never too early to seek investment counsel. And there can be people that would still speak with you and you can take away some important pieces even if you don't have enough to work with them. And if you don't have enough to work with the advisor you'd like, there are other options. There are more robo type advisors that have lower to no minimums where you can get in. I'm also happy to suggest certain funds you could hold on your own during that period. That would put you in a well-balanced approach. Utilizing low-cost index funds and keeping it simple for the time being until your assets do grow. But I would say it's never too early to start thinking and trying to speak to an advisor and maybe looking up advisors in your area or online that work with clients of your size because it's never too soon.
Thanks, Dan. Another question we have is, can you please explain in more detail passively managed index funds? How passive are they?
Yeah, so an index fund is in some ways inherently passive. The index fund, what it's doing is it's tracking an index verbatim, you could say. So the S&P 500, it holds the 500, largest companies. It tends to be a good barometer of our, it's an okay barometer, but it tends to be, related to our economic health. But really, and it covers different sectors, as we know, technology, manufacturing, insurance. When one company falls out of the S&P 500, another company's market cap has gone bigger than theirs, and there's a shift. And so that happens. One company will fall out, another company will move in. The index will mimic that in their fund. And so when that happens with the S&P 500, the index funds, and there are many S&P 500 index funds. Every bank and custodian offers one. That'll mimic that change. And similarly, if you're in emerging market countries stocks, if you're in a bond ETF, so essentially the index funds will track an established index that has an established track record and history to it that you can look up. And that's why it's considered passive because it's based on what's happening in the market or these index changes, and it's not being done by an individual.
Great. Dan, I think we have time for just one more question. So we're going to go with, how complicated is putting together a financial plan and what does it entail?
Perfect. I love that question. There can be varying degrees of financial planning. You can do your own financial planning on an Excel spreadsheet, looking at your expenses versus your income on a monthly basis and saying, hey, does my budget make sense? Your own financial planning at the very rudimentary level can be, what am I saving annually, monthly? What am I putting away? What am I contributing to retirement accounts? What am I putting into my taxable accounts or saving for upcoming expenses? What do I need for rent and this month's expenses as well? So that's one version. But as far as how complex and nuanced it can get is really endless. And that's the beauty of it, is these softwares now allow you, the process is taking, looking at your total assets that you have and your total liabilities, any debt that you owe. Then we'll be looking at total income and expenses. And we enter in as much information as we can, detailed about your financial life, around insurance and, it could be disability insurance. And then we model out future outcomes. So we're looking at, Is there a chance you may need to go into assisted living in your 80s or 90s? When do you want to take Social Security? When can you retire in general? How much assets do you need to retire? And so it's really taking an inventory of all of your data today, using some assumptions and modeling to project that into the future, and allowing us to back into some of these decisions of how much you need to retire. Do you, should you be, do you need to be making more money or being a little more frugal in your lifestyle to meet your goals? And so it's really, financial planning is one part of it all, but I don't see how really you run a wealth management business without that aspect, because it really informs the amount of risk you should be taking in your portfolio. Because if the picture doesn't look how you want in the financial planning side, then you can make adjustments today. And as we showed, the earlier you make an adjustment, a 2% or 1% return can equate to hundreds of thousands or millions of dollars over time. So financial planning, can start with you doing it yourself. And then, as you partner with a financial professional, they should be utilizing one of the premier softwares available, and either sharing their screen to walk you through with that, or updating the reports. That should be a part of the conversation.
Awesome, Dan. Thank you so much. That's all the time we have for today, but I do just want to make sure that anyone who asked questions that we didn't get to know how to find us, or if you have a question that you're thinking of now and didn't get answered that you might want to after this call, that you know where to reach us. So I mentioned the investment committee at the beginning of this call. This book was actually written by 2 of the members on the investment committee. And just for attending this event, we're actually offering it to everyone who schedules a call with us as a result of using this QR code. So all you have to do is click the QR code or this link that I will put in the chat box, and we will actually send you your very own copy of The Elements of Investing. So this is a great book by Burt Maciel and Charlie Ellis of our investment committee, and it's an excellent beginner's guide. These are just the basic best rules of investing by 2 of the world's greatest financial thinkers. So it's a quick read, but it packs a punch, and it will truly change your perspective on investing. If you have any further questions, again, you can use this QR code to schedule a call, and you'll get a free copy of the book. If you're not ready to schedule a call, or you just have a one-off question, Dan's contact information is here as well. So you're welcome to send him an email, and we'll make sure it gets to the right person. So Dan, thanks again for speaking to us today, and thanks everyone for attending.
Thanks so
Thanks,
much,
everybody.
guys.
Thank you,
Yeah,
Nina.
this
Go
was
Green Wave.
awesome.
Pleasure to speak with
Yeah.
you. Really, really, what a really great experience for us. So thank you so much.
Thank y'all. And I'll be in all your inboxes with all this information as well, in case any of you missed it or had to leave early. So thanks again, guys. This was so informative. I know I feel very, very helped. So it's good
Well,
stuff.
great. Yeah, and if any follow-up questions, so genuinely, please just reach out. I'd love to close the loop on anything if anything wasn't clear, so that you have some steps moving forward.
Perfect. Thanks, guys. Have a good rest of your
Bye-bye.
day, everybody.
Thanks so much.
Bye.
Take care.